those who don't know me, I am Adam, and my name is Adam Dolby. I'm a chartered financial planner. And in today's session, it's going to be some basic level stuff. Obviously, we're doing financial wellness webinars, and the idea today is going to be to just go through a few foundational financial literacy stuff just to build up your base knowledge and tell you everything that you need to know about investing as a complete beginner. So in terms of a rough agenda, just before we get into things, just so you can keep track of where we are and what we're going to be going through today. This is a rough agenda for the next half an hour or so. Forgive me if I go slightly over that. I tend to talk quite a lot, but I'll try and keep it tight to about the 30-minute mark, and we get into a few Q&As after that if there are any. But yeah, look, in terms of what we'll run through, I think before we get into investing, I think that the first place to start is always the why of it. So why is investing so important? We can talk a little bit about that. Then once we've got a good grasp on that, we can then look at what are the options. So what can we actually invest in? I know, especially in this day and age, the world of investing can sound incredibly complicated. So we can just discuss through the options there and try to keep things as simple as possible, make things as easy as possible for you to understand and tune out a lot of that sort of noise that exists in 2024 around the subject of investing. Then on to, well, I think I should just say, I think we'll probably spend most of the time on discussing through those options. So that's where we'll spend the bulk of our time. But then we'll also touch on then how to invest sensibly for the long term. So what are the sort of key rules and key foundational bits of knowledge that we want to live by, basically to deliver us to our long-term goals. How do we get from point A today to point B in the future? And then finally, I know Shariah compliant investing is becoming more and more popular or in demand, especially in this part of the world. So I'll try and touch on that before we finish up. And then finally, then Q&A, and we can go through any questions that you might have. So I hope that's useful just in terms of outlining things for you, a skeleton for the next half an hour or so. So yeah, why is investing so important? I think this is the best place to start. So before we get into the nuts and bolts of investing, what it is and how it all works, I think it's important to give this whole subject some context. So the best place to start is with understanding the why. So why is investing so important, and why is it so important for us to invest our hard-earned savings? And the biggest reason for this is inflation. So simply put, inflation is just the measure of how prices rise over time. So this graph that you should be able to see now on your screen is showing you inflation, the green line, versus cash just sitting in the bank earning nothing. So that's the red line. And I guess to give you a more relatable example of how inflation works, when I was a kid, there was a chocolate bar called a Freddo bar. So if there's anybody on the call from Ireland or the UK or Europe, they'll be very familiar with a Freddo bar, but ultimately it's a chocolate bar and that's quite popular. And so look, well, there's also a fun inflation tracker, I should say. So there's a fun inflation tracker called a Freddo index that tracks the price of a Freddo over time. So when I was a kid, a Freddo cost 10p. So I could walk into a shop with £1 and come out with 10 Freddo bars. But roll on to today, a Freddo now costs 27p. So if I went into the same shop with the same £1 today, I could only afford 3 Freddos. So you can see how, even though I didn't feel like I'd lost any money, I still had my £1, i.e. this red line on the graph. My £1 has always been there. But when I walk into that shop today, my £1 is worth a lot less. So inflation has completely eroded the real value of that £1. So where I could afford 10 Freddo bars, I can now only afford 3. So that's an incredibly important concept to understand. And that's why investing is so important. So we want to invest our savings so that our money keeps pace with inflation, so that we can maintain our lifestyle. And if anything, we actually want to grow our money above inflation, so above this green line, so that we're improving our lifestyle over time, so that instead of 10 Freddo bars, we can afford 13, 14, or 15 Freddos, or whatever is more relevant to how you spend your money. So now that we understand why investing is so important, and we have that sort of foundation or that cornerstone to the way we look at investing, the next question is, what do we actually invest our money in? And this is where I guess the subject of investing can start to get complicated and people can start to feel overwhelmed with the amount of information being thrown at them. But the good news is that it really doesn't have to be complex. So investing is really just a decision that you have to make about where to hold your money. And you really only have to think about 4 options here. So there are 4 main asset classes or different types of assets which you can choose to hold your money in. And especially as a beginner, as you know, being introduced to this subject, you can pretty much ignore everything else and just focus on these 4 asset types. So the 4 main asset classes are number 1, cash, number 2, bonds, number 3, stocks, and number 4, property. So you can actually break these down further into 2 categories. So if you think about the first 2, cash and bonds, they're what we call defensive assets, while the second 2, stocks and property, are what we call growth assets. So defensive assets are more stable and help to protect your money, while growth assets are more volatile over the short term, but they help to grow your money into the long term. So let's just go through each of these in a little bit more detail so you've got a general understanding of what they are, the pros and cons of each, and most importantly, when you should actually use each of these 4 asset types. So starting with number 1, cash. I'm not going to spend too long here because cash is obviously one of the asset classes that everyone will be very familiar with. It's the money that we spend, whether that's digital by tapping cards, paying with Apple Pay, Google Pay, etc., or physical money by taking actual cash out of our wallets and spending it. But I think it's also important to note that cash is also the asset class that our money generally defaults into. So most of us are paid salaries in cash into our bank accounts. So we have to be aware of that and proactively look at it to decide, is this the correct place for our money, or does that money need to be moved into one of the 3 other options? And that's something that trips up the vast majority of people, and they sleepwalk into keeping their long-term savings in the wrong asset type. So it's important to be conscious of that fact and just make sure that you're intentional about where your money sits and why. So here's the same graph again, but just to put cash in context versus inflation. So we're looking at inflation over the last 20 odd years. And just for reference, these are UK numbers, so UK inflation versus cash just sitting in the bank since 2004. I'm using UK numbers, but obviously this is going to look pretty similar around the rest of the world. And so, yeah, I think this is really important to look at. So let's just go through some of the pros and cons of holding cash. And I think, starting with the pros, as you can see from this graph and from the red line at the bottom here, cash is incredibly stable. The value never fluctuates around at all. So if you've got, say, 20,000 dirham in your bank account today, that's still going to be 20,000 dirham tomorrow. It's still going to be 20,000 dirham next month, and it's still going to be 20,000 dirham next year. And that is exactly what you want when you plan on spending money soon. So when we're spending our money, we want the certainty that the correct amount of money is going to be there when we need it. We don't want the uncertainty that would come from our bank balance fluctuating around constantly. Then in terms of cons, there is another side to that coin. So the reason cash is so stable is because it's completely unproductive. So the value of cash doesn't move because cash quite literally does nothing. So it just sits there until you spend it. And that means that your money is not being used for anything productive. It's not being used to grow your money. So it's going to be eroded by inflation over time, which is what you can see in the graph here. So if inflation is 2% per year, then you're going to lose 2% of your money each year if you simply hold it in cash. And I think a good way to think about this is to think about keeping money in cash like keeping water in a leaky bucket. So if you focus on the early stages of this graph, if you're only going to go a short distance, then you'll only spill a little bit of water and you'll have enough water, or you'll have the water that you need when you get to where you're going. So it's not really a big deal. But if you look at the back end of this graph, if you're going to go a long distance, then the leak in the bucket becomes a much bigger deal, and you probably won't have enough water left by the time you get to where you're going. So when do we actually use cash? We use cash for our immediate and short-term spending needs. That's what cash is for. So as a rule of thumb, any money that we plan on spending within the next 0 to 5 years. In the immediate term, we obviously need to have enough cash to cover our day-to-day spending and live our lives comfortably and normally. But on top of that, we also want to keep our savings in cash if we have any other big expenses coming down the track that we know we won't be able to pay for out of our regular income. So a very common example is, say you want to buy a house this time next year. If you have 600,000 dirham sitting in your bank account right now, and you know that you're going to need that 600,000 dirham for the down payment or the deposit, then you're probably just going to keep that money in cash. So sure, you might lose 2 or 3% to inflation, but what does that really matter in the grand scheme of things or in relation to what you're trying to achieve? The most important thing is that the money is there when you need it. So over the course of 12 months, inflation is only going to have a minimal impact, and you're going to have a big benefit, or the main benefit is going to come from the certainty that the money is going to be there when you need it. And that far outweighs any negative short-term impact that inflation might have. So think again about the graph on the slide before. So if you're going to be buying a house in the early stages, then inflation is not going to have a huge impact. But over longer periods of time, so 5, 10, 15, 20 years towards the back end of this graph, that's where inflation really starts to compound and snowball, and it's going to completely destroy money that is kept in cash. So we never want to keep our money in cash for longer periods of time like that. Next, we have bonds. So this is where things start to feel a bit more complicated, but don't worry, at their core, bonds are actually quite easy to understand. So just think about bonds like an IOU, except instead of lending money to your friend and giving them, instead of lending money to your friend and then giving you an IOU, you lend money to a company or to a government. So bonds can come in the form of both corporate bonds and government bonds. And with bonds, there are 3 key parts to understanding them. So number 1 is the amount. So for example, if I'm going to lend a company, or I decide I'm going to lend a company $1,000. Number 2 is the maturity date, which is just the repayment date. So for example, the company agrees to pay me back in 5 years' time. And then finally, the interest rate. So to compensate me for lending them money, the company agrees to pay me 4% interest per year until we get to the repayment date, and they pay me back my original capital. And bonds are another defensive asset, so considered low risk, but they will be slightly higher risk than cash because your money is actually going to be used somewhat productively to earn a little bit of interest. So let's get the graph back up and just add bonds in for context. So with bonds, the return that you get, which you can see here, is sort of outpacing inflation, is quite simply just the interest rate that you earn. So how much interest you earn depends on the risk that you take with the bond. And when it comes to bonds, the main risk really is around who you lend your money to. So again, think about an IOU between you and one of your friends, and you probably have some friends who you'd have no issue at all lending 100 dirham to. You know they're good for it, you'll get the money back, and you'll never stress or worry about it at all. But on the other hand, you probably have some other friends who, if you give them that money, you'll never see it again. So bonds work in exactly the same way, but with a little more legal framework and regulation around them. So for example, at the safest end of the spectrum, and think about it like a spectrum, at the safest end of the spectrum, you'll have bonds like government bonds, or US government bonds in particular. So the US government is probably the most powerful institution on earth. They've never missed a bond payment ever. They've been around for hundreds of years, and you can be pretty confident that they will still be around to pay you back when the time comes. So the US government doesn't have to offer a very high interest rate to make it attractive for people to lend them money. Now, if you think towards the other end of the spectrum and think about a small company with very little history and a name you don't recognize, they're going to have to offer a much higher interest rate to attract people. Otherwise, why would anybody lend them money when they could just lend it to someone as safe as the US government and earn the exact same amount of interest? So typically, the higher risk the bond is, the higher the interest rate that you'll earn by lending them money. So going into pros and cons, starting with pros, I think pretty clearly from the graph here, there's an obvious one. Bonds allow you to generate a small return and let you grow your money better than cash will, so above inflation. So you'll have a much better chance of protecting the real value of your money and keeping pace with inflation by keeping your money in bonds rather than cash. They are also a defensive asset, so low risk, and that means that they're well, defensive assets, or the definition, I guess, of a defensive asset means that they're great for money that you care more about protecting than aggressively growing. And you can see from the, I guess, the smoothness of the lines here on the graph, so the blue line being bonds, that the value will fluctuate around a bit more than cash. You can see the red line is completely flat. So it is going to fluctuate around more than cash, but it's still going to be pretty stable compared to growth assets, which we'll get onto and show you a little bit later on. So I think the key takeaway here really is that you're going to have a much better chance of protecting the value of your money and keeping pace with inflation if you invest your money in bonds rather than cash. Then going on to cons. Although you're going to be able to earn a little bit of interest and give yourself a chance of keeping pace with inflation, you're probably going to struggle to really grow your money significantly above inflation by investing just in bonds. So if I go back to the example of the Freddo bar from earlier, by investing in bonds, you might make sure that you're always able to buy those 10 or maybe 11 Freddos, but you'll never be able to afford 15 or 20 Freddos. So when do we use bonds? Now, there are probably two main uses for bonds. The first main use is for short-term or short to medium-term money. So, for example, if you've already thought about your cash needs over the next 12 months or so, then any big expenses that you see in the next 2, 3, 4, 5 years, and that's all sorted and you're all prepared for that. And now you're starting to think a little bit further out. So say 3, 4, 5, 6, 7 years away. Your timelines are now far enough out that you'd like to generate some return and protect your money against inflation, but they're not so far out that you're comfortable putting your money into growth assets for the long term. So in that situation, bonds can be a great low risk place to park your money for a few years. And then the second main use for bonds is as part of a wider investment portfolio. So lots of people will invest in both bonds and stocks to get a nice balance between defensive and growth assets. And that way, when growth assets go through a rocky period, bonds can help because they act as a sort of safety net to dampen the impact and smooth out your investor experience, and ultimately make it a lot easier to sleep at night, which is the main thing. So the third asset type is stocks, or the stock market. And this also brings us nicely onto growth assets. So I think it's worth just touching on that now while we're here as well. And the key thing to remember about growth assets and how they differ to defensive assets is that growth assets represent ownership. And ownership is where real growth comes from. So if you think about the defensive assets that we've just run through, you don't actually own anything. So with bonds, for example, you're only lending money to a business, so you don't own the business or benefit from it in any way. So, for example, if Apple take your money and use it to expand the business, come up with new technologies and new products, generate more profits, etc., then you're not entitled to any of that if you are a bondholder. They simply just pay you your money back when the time comes. But with growth assets, you own the asset, so you benefit fully from it. So whether that's a company or a property that you own. So I guess focusing in a little bit, or refocusing back into stocks in particular, or specifically, so stocks or shares or equity, all basically different words for the same thing, just in case you've heard any of those words being thrown around in conversation and have wondered what they are. We're just talking about stocks, company shares, the stock market. It's all the same thing. So let me add stocks into the graph again for context. And what we're looking at here is the global stock market. So you can see, I guess, what that does to the graph. So yeah, look, stocks, simply put, represent ownership or part ownership in a company. So that'll title you to two things. Number one is growth. So as the value of the company grows, you benefit directly from that. And the second point is income. So companies sell products or provide services which generate revenues and profits. And as a shareholder, some of that profit is then paid out to you in the form of dividends. So what are the pros to stocks or the stock market? As you can see from our graph, stocks provide the highest returns. So stocks are by far the best type of asset for building real long-term wealth. By investing your money in the stock market, you give yourself the best possible chance at growing your money significantly above inflation. It's easy to diversify. So diversification is this idea of not keeping all your eggs in one basket. And with stocks or the stock market, it's easy to invest in pretty much every major company in the world. So You can build a portfolio that's globally diversified across every single country and every single industry. It's cheap to access, so there's virtually no cost to setting up an investment portfolio or buying stocks. And I think closely connected to that, there's no minimums, or at least very low minimums. So I think most people think that the stocks or the stock market, it's for the super wealthy, the richest people in society. But that's not true at all. And in fact, that's actually a big reason why the wealthy get wealthy in the first place. It's because they start investing from a very young age. So unlike with, say, property, for example, where you'll struggle to find a property for under 6 figures or 7 figures, even if you're talking in dirham terms, you can start investing in the stock market from zero. So most investment accounts or investment platforms that you would use will let you start from usually as little as $100 or so. Then finally, a big one is high liquidity and visibility. Now, I put these two things together because they are effectively the same thing. So stocks are priced live, so you have clear visibility and you can see the value right now. Now, that also means that it's liquid. So you can sell right now as well. So that just means that you can convert it back to cash very, very quickly. So if you ever need access to your money for whatever reason, you just decide on the amount that you need and it's back in your bank account as cash within a few days. As with anything, there's also a few cons when it comes to investing in the stock market. And one of them is that same point again. So high liquidity and visibility. So yes, practically speaking, high liquidity and high visibility is a good thing. Stocks are priced live, so you can see the value anytime you want and you can sell anytime you like. But unfortunately, people, well, I say unfortunately, probably fortunately, people are not robots. And so psychologically speaking, that can actually be a bad thing because it means that you probably have too much visibility and you can see the value fluctuating around even when you don't need to be looking at it. And you don't need the money. You've got no intention of selling for a long time. It's money that you plan on spending in 10, 15, 20 years. So those short-term fluctuations are completely irrelevant to you, really. And over short periods of time, from say day to day, month to month, or even sometimes over a year or two, the value that you see will fluctuate around a lot. So that can lead to nervousness, knee-jerk reactions, and mistakes. Ultimately bad investor behavior, which is probably the #1 danger when it comes to building long-term wealth and your investments. But again, looking back on the graph, over long periods of time, stock market performance becomes a lot more reliable and predictable. And if you're accessing and harnessing the power of stock markets properly, you'll capture this, which is ultimately, the fact that stock markets tend to trend up and to the right over the long term. So as a general rule, I think this is really, really important. You should only invest for the long term, but also over the short term, you should avoid checking your portfolio. So don't check your portfolio regularly, just check in with it once or twice a year. Or if you can go even longer than that, then brilliant. So that brings us nicely on to when do we actually use stocks, or when should we be investing in the stock market? And simply put, we use stocks for our long-term savings. So stocks are not suitable for money that you need in the short term. So going back to the example of the house deposit from earlier, imagine if you had your 600,000 dirham ready to go and you decided to invest it in the stock market, and then you needed to pull that money out a year later to put down your house deposit. If you look at statistics, so statistically speaking, there's around a 60% chance that you will have made money. So that means there's a 40% chance that you will have lost money. So over really short periods of time like that, it's almost a coin toss on whether you're going to be up or down. Now, we know that's a lot more reliable and pretty much 100% if you stretch out the timeline far enough. But if you're looking at a short period of time like this, between now and this time next year, over a 1-year period, it is almost a flip of a coin, whether you're going to be up or down. So if you gamble on that and you end up having, say, 650,000, then that's brilliant. But if you lose and you end up having 550,000, then you're not going to have enough money to put down your deposit, your down payment for the house. And then all of a sudden, life gets very difficult, right? You need to scramble to find a spare 50,000 dirham from somewhere, which not everyone can do. And even if you can, it's probably going to cause a whole lot of stress that you simply just don't need in your life. So as a rule of thumb, think about the 5-year rule. Only start to think about investing in the stock market if you're thinking about money you're not going to need for at least 5 years, and ideally 10, 15, or 20 years. So the fourth and final asset type is property. So along with cash, property is the other main growth asset, or sorry, along with stocks, property is the other growth asset. Comparing it to cash, property is probably the other main asset type people are more familiar with. And so, yeah, I guess where to start with property. I think property is very much like investing in stocks. It's a growth asset, and again, it represents ownership, except now it's just a property that you own instead of a business. So let's just add property into our graph, and you can see it there. Yeah, the purple line here, which is labeled as B. So again, I'm using UK house price data here, which is the average house in the UK between 2005 to now. So when it comes to property, investment returns are generated in the same way. First of all, you've got growth. So as the value of the property increases, you benefit directly from that. And number two, income. Now, that is a little bit more difficult than with stocks because properties aren't productive in the way the companies are. But if it's an investment property, for example, and not your main home, then you do have the potential to rent it out and earn a rental income from it. So getting into the pros and cons, starting with the pros. Property, again, it's another growth asset, so it's going to help you to build wealth and grow your money above inflation, which you can see from the graph here. It's a tangible asset, so I think that can be a big thing for a lot of people. And you can see it, you can touch it, you can feel it. Now, to be honest, that doesn't actually mean a great deal or anything at all, really, but it can be comforting. Well, it can be comforting for some people, so it's worth mentioning. You do have the ability to leverage. So, i.e., we're talking about taking out a mortgage here. So you can purchase the property with a small down payment and then finance most of the cost by borrowing from the bank. Now, I guess the benefit there is that you benefit from the growth on the entire asset, which can be particularly valuable for younger people because it allows them to have a big six-figure asset sort of growing and compounding for them early in life. And I guess the obvious question here is, why not borrow money and invest in the stock market as well, which you can do. You can borrow money to invest in stocks as well, but without getting, I guess, into the detail or into the weeds of this, it can be a lot more complicated and it can carry very specific risks. So it's generally considered more sensible to do this with property than with stocks. I'm going to put low liquidity and visibility here as well. So visibility and liquidity is completely flipped and works in the opposite way to stocks. So you can't see the value of your house live. There's no digital scoreboard in your front garden showing you the price that passers-by are willing to pay for it. And so most people only value their house on the day they buy it and the day they sell it. So if there's a long time in between those 2 points, then the property will probably have risen in value and you're going to be happy. So from a psychological perspective, that's a really good thing. You haven't seen all the peaks and troughs along the way. Moving on to cons. Again, I have to address the same point. So low liquidity and visibility. So as we know, the downside to that coin is that property is illiquid. So property is not priced live. So you can't convert property into cash to spend quickly. So it can take a long time to actually get your money. So just to give you some numbers around this, according to data from Zoopla, which is a big property website in the UK, the average house sale in the UK in 2023 took almost 6 months. If you look at the UE data, it's slightly less reliable, but as of February 2024, the local data suggests between 40 to 60 days on average. So it can take a long time to get access to your money. And I guess another factor there is the lack of flexibility. So you've got no flexibility around how much you want to withdraw. So if you have a house worth, say, 4 million dirham, you can't just withdraw 500,000 dirham. You've got to sell the entire property. You can't just sell a bedroom. So that can also potentially lead to another problem if you do actually have to sell the property to release a small amount of money. Then what do you then do with the rest of the money once you've sold the house? So there can be a few things going on there. It's also very hard to diversify with property. So unless you're incredibly wealthy, it's far too expensive to own, say, 30 plus properties, and pretty much impossible to own 10,000 plus like you might do with company stocks. So therefore, it's impossible to diversify away the high risk profile of a concentrated investment, which basically means that you're almost forced to put all of your eggs in one basket or one or two baskets. Bad tenants and vacancy periods is another big one. So most landlords have at least one story about the nightmare tenant, the period of vacancy, where there was no rental income coming in, for example. And then finally, I think the cost of property is something that often gets overlooked. So unfortunately, there's just no getting around the fact that it's expensive to own property. So there's probably three phases here, when you buy the house, when you actually own the house, or during the period you own the house, and then finally when you sell the house. So I guess just to touch on each of those 3 points, the initial costs are quite high when you buy a house. So between survey costs, mortgage valuation fees, mortgage arrangement fees, lawyer fees, transfer fees, life insurance usually needs to be, always needs to be arranged. There'll be removal costs from your old place, furniture, white goods, the fridge, freezers, all of that stuff, redecorating, and even things like stamp duty and taxes if you're buying a foreign property, which is something that we see UK expats do a lot, for example, or even locally DLD fees here in Dubai. So it is quite expensive in terms of that initial barrier to entry, that first hurdle you've got to get over to actually own property. And then while you actually own the property, ongoing costs are actually pretty high and a lot more expensive, I think, than most people realize. So a lot of people tend to focus too much on the headline rental income figure, but it's important to make sure that you're still happy with it, net of all costs. So be it water, gas, electricity, any taxes that you have to pay, service charges, maintenance costs, and so on and so on. So as a rule of thumb, expect to spend between 1% to 2% of the property value on maintenance each year. So for example, that could be up to $20,000 a year on a $1 million property. And then finally, at the end, costs can still be quite high when you go to sell the property. So whether it's work preparing the house for sale, the estate agent fees, or on foreign properties in particular, things like capital gain tax that you might have to pay. So property is even expensive when you're trying to sell it. And then I guess the last point here, I know I said finally when it came to expenses, but I think one final point to mention on property is that it's also very time consuming. So managing and letting a property takes time and effort, which is not something that most people typically want to add to their lives. So when do we use property? It's another growth asset. So like the stock market, we only want to invest our long-term savings into property. So again, think about the 5-year rule. Ideally, this is money that we don't need for decades. But ultimately, I think property is maybe not the most efficient investment. It's certainly a lot better than other types of investing, be it, just leaving money in cash, for example, significantly better than that. But it's not the most efficient investment. So ideally, the main use of property is simply just to give you somewhere to live. So how do we invest sensibly for the long term? So what are we talking about here? We're talking about investing in a way that will be robust and reliable, that's going to get us to our ideal financial futures. And so I'll try and be relatively brief here. I'm aware of time, but I'll just run through this for a couple of minutes. I think the way I would describe this is, for example, we have an investment philosophy at Abacus. It's the firm that I work for, and I sit on the investment committee at Abacus. So when we're designing client portfolios, we have our investment philosophy, which has 4 key pillars. So we make sure that all clients' portfolios are consistent with this investment philosophy. So let me just run through each of the 4 points to give you some, I guess, general rules or pillars of the investment philosophy that you always want to be sticking to. So the first point is effective diversification. So you want to be spreading your money all across the world. I know this is something that we touched on earlier, but yeah, that is how you want your money to be invested all across different geographies, different countries, different industries, different types of companies. And there's 2 main reasons for that. On one side, you've got risk, so managing risk by diversifying across all of these different countries and different industries. You're spreading your risk, so the impact of, say, one country having a bad year, or one market having a bad year, or one industry having a bad year, the impact of that on you is limited. So again, spreading your eggs across many baskets. And then the other aspect of that is growth. So you'll hear, I guess, in the media sometimes something called the randomness of returns being mentioned, which basically just refers to the fact that it's almost impossible to predict where returns are actually going to come from year on year. And if you try and guess those things, you might get it right once, but it's very unlikely that you get it right consistently year after year after year for the next 20, 30, 40, 50, 60, 70 years, i.e. the amount of time that you plan on being alive for and will be an investor for. So it's very important to diversify all across the world so that we are tracking and we're exposed to where growth comes from. So if, for example, New Zealand is the best performing stock market in the world one year, then you're exposed to that. If the US is the best performing stock market in the world, you're exposed to that. And no matter where growth comes from within the market, you're exposed to that and you will capture that effectively within your portfolio. The next point then is around controlling costs. So, ideally, we want to be investing in as low cost a manner as possible. So I don't think we necessarily want the cheapest. I think, like most things in life, sometimes the cheapest isn't always best. So the word control here is very intentional. But ultimately, we want to be investing in the most efficient way that we can. And then once we've identified that, we then want to be doing it or executing it at the lowest possible price point. So that's the way I would describe that. At the end of the day, the more that you pay out in fees, the less return that actually ends up in your pocket, which is going to harm your ability to sort of compound and grow and build wealth into the future. So controlling costs is really important. If you can get access to the same investment fund, for example, or two investment funds that are exactly the same. So for example, if you have an S&P 500 tracker, which tracks the top 500 companies in the US, if you have one fund that costs 1% a year, and there's another fund that costs 0.2% a year, then you'll obviously pick the one that's 0.2 because it does exactly what you're looking for at the lowest possible price point. So controlling costs is very important. Avoid speculation, and this is really important. And unfortunately, in this day and age, this is something that people get distracted by a lot. With, I guess, social media in particular, there's so many, I guess, at the more cynical end of the spectrum, investment scams being promoted out there, and at the, I guess, less cynical end of the spectrum, I guess, unqualified people promoting extremely high risk investment strategies, or, well, gambling ultimately, whether that's it can be anything ultimately. I won't name names or name specifics, but I'm sure you all know what I'm talking about, especially when it's people selling courses and all the rest of it. So I think what you want to do is make sure that you're investing properly. We've gone through the main 4 asset classes, and so stick to those is what I would say. They are the definition of an investment, any of those 4 asset classes, or I guess the 3 really, between bonds, stocks, and property. When it comes to speculation, there is actually a definition for investing versus speculation. And speculation basically comes from something that has no sort of actual value. So if you think about stocks, for example, a company has value. It produces things, it produces an income, it produces cash flow, it produces profits. So there is something tangible there. With property, it's the same thing. So you've got an actual tangible house, for example, and you've got a rental income that it's producing. So investments are productive is the word. If you have a sort of high risk speculative investment, it's not really an investment at all. It's a speculation, so to speak. So that could be things like cryptocurrency, for example, is something that's come up a lot recently, where there is no real value to it. It's just based on what's called greater fool theory. So it relies on a greater fool than you coming along and paying more for it than what you paid for it. So it doesn't produce anything. It doesn't sort of add any value to the world. It just sits there, and hopefully you can sell it for more than what you paid for. And so there's no real value in there. So that can be anything really. I mentioned crypto, but there's no end to these types of investments that are ultimately closer to gambling than they are investing. So I guess to name a few things like art, for example, classic cars, whiskey is one that I came across recently as well. And so there's plenty of things to like about that kind of stuff, to be honest. So, if it's a hobby, fine, but just don't see it as investing, for example. So avoid speculation when it comes to, I guess, the family fortress, the core of your investment portfolio and what's going to deliver your family's future and your financial future. And if there are things on the side you want to do with a small amount of money, then feel free to speculate. But as long as you're looking at it through the lens of, this is gambling or this is a hobby, this isn't sort of my core investment portfolio that's going to, I guess, deliver my long-term life objectives and goals. So avoid speculation, focus on real investments. And then finally, keep turnover low. So this is something that I would probably split in two parts. So at a more technical level, within the investment portfolio, I'll just touch on that briefly because I appreciate it's a bit more technical, I suppose. But within the investment portfolio, you don't want to be constantly chopping and changing. So you don't want to be buying this fund, selling that fund every week or every month. And the same with the actual underlying funds that you use. You don't want to be using funds or fund managers that are constantly buying and selling and trying to pick the next best thing, because that is ultimately going to drive up cost within the portfolio as well. And it usually doesn't add any benefit. So keep turnover low, decide at the beginning or at the outset what your investment goals are going to be, what you're trying to achieve with this money, and then set the portfolio in line with that. And then only really change your portfolio when, your personal or financial circumstances dictate a change, right? Your goals and objectives have changed, so therefore the way you handle your money needs to change slightly to make sure that it's still aligned. But otherwise, day to day, you shouldn't be sort of involved with high turnover within the portfolio. And then the same, I guess, zoomed out, the second point then is with your own behavior. So again, you should have, when you invested money, you should have identified what your goal is for the money, what you're going to use it for eventually. That should be, I guess, your focus. You should be laser focused on that. And any short-term sort of movements and all the rest of it should be expected. And therefore, you don't actually do anything when those times come. So you yourself don't want to be dipping into the pot, putting money out, adding money back in, taking money out, putting money back in, so on and so forth. You want to be investing when you have the money, pulling it out when you need the money, and hoping there's a very long time in between. And then finally, just before we wrap up, I think it's worth touching on Shariah compliant investing. So there is definitely an increasing demand for Shariah compliant investing, especially in this part of the world. It has become more and more popular in recent years. I think when I first started in the industry, there were very few options when it came to Shariah compliant investing. Fortunately, now there are not loads, but there are quite a few options out there for Muslims looking to sort of invest and grow their money in line with Shariah law. So I guess to go through the two elements to this, I guess the most common way you would see a Shariah compliant investment portfolio built is if you look at the growth side to the portfolio. There are plenty of Shariah compliant investment funds out there now that will let you access or harness the power of global stock markets, but they will filter the companies that they invest in so that the portfolio of the fund is Shariah compliant. So you usually have to put together maybe a portfolio of a couple of different funds to get the exposures that you need. Again, going back to the investment philosophy and I guess particularly that effective diversification point. So to track the entire world's global stock markets, you might have to, I guess, knit together a couple of different funds, but it should be pretty straightforward and there are plenty of options out there. So that's the growth element of the portfolio. I guess where it gets a little bit more tricky is on the defensive part of the portfolio. So if, I guess, like the majority of people, 100% growth portfolio is not going to be suitable for you based on your attitude to risk and your risk profile and all of that, you're probably going to want to have some defensive element within the portfolio. And that can be the bit that gets quite tricky with Shariah compliant investing because of, I guess, the way bonds pay at interest, which doesn't align well with Shariah law. So the main way you would see this sort of bypassed is with the use of gold. So within most Shariah compliant portfolios, the defensive element will be done using gold. Now, I guess the more tuned in the crowd might recognize that gold probably falls under the the avoid speculation point that I mentioned earlier. So gold would be what's considered a speculation rather than an investment, because gold doesn't produce anything. It just sits there, and we hope that someone will pay more for it than what we paid. But in this situation, it's probably one of the only situations where I would, I guess, suggest using gold, or proactively suggest using gold, or at least overweighting gold within a portfolio, because it is a good way to, I guess, replace the defensive elements of that, well, inflation proofing defensive elements that bonds provide in a standard portfolio. It's a great way to sort of replicate that, or get as close to replicating that as possible within a Shariah compliant portfolio. So that's normally what a Shariah compliant portfolio would look like. Growth elements coming from Shariah compliant investment funds into sort of global stock markets, which then filter out Shariah or certain companies that don't align with Shariah law, and then the defensive elements coming from mainly gold. In terms of options, there are plenty of options out there now. So yes, admittedly not as many as standard portfolios, but in this part of the world especially, there are a couple of firms that do it. So we do have clients at Abacus invested in Shariah compliant funds. So if you are interested in speaking to us and you have wider, I guess, financial planning concerns, retirement planning, tax planning, any of that kind of stuff, then I guess full advice firms like us can do that. But if you're just looking for somewhere just to invest money, I guess you've got lower amounts of money, you don't need anything too complex in terms of wider advice, you just need somewhere to start saving and investing, but you want to do it in a Shariah compliant way, then there are plenty of sort of DIY investment platforms that you can use. Things like Interactive Brokers, for example, would be a very commonly used one, where you can just pick your own Shariah compliant funds on there. Or if you want to go halfway in between, there are now a lot of what we call robo-advice firms, which automate that decision making for you and will be cheaper than sort of full advice, like, I guess, Abacus fees, for example. So Sarwa, for example, is a company that some people on here might be familiar with, who I believe now do Shariah compliant versions of their portfolios. So there are plenty of options out there now when it comes to investing and doing it in a Shariah compliant way. I think a few years ago, or a number of years ago, this was a big hurdle, and obviously you had people who were looking to do the right thing and be sensible and invest for the future and set themselves up for financial freedom, and look after their families and future generations and all the rest of it, but maybe we're struggling to find Shariah compliant ways to do that. So fortunately now there are a few options for you to go and do that, which is great. And yes, the use of goals of the point I mentioned. So look, I think that about wraps us up. I'm aware of time. I've got 9 minutes to go to the top of the hour, which I think is slightly more than I was supposed to do. But hopefully that's been useful. I'll wrap it up here, and I will open it up to a Q&A if we have any. I'm not sure, is Shivani back now, or if not, just bear with me and I will drop into the Q&A box and see if there's anything in here.
Hi, Adam. Yes, I'm here.
Oh, perfect.
All right. So yeah, we definitely have a few questions. I see the first one goes like, hey, I would like to ask about investments in Salik, parking, ADNOC logistics, etc. Is it a good deal, and how much one needs to invest to receive a good RE?
Yeah, great question. And this is something I think that it has become more and more popular over the last few years. I think the way local companies are marketed at the moment has become much better. So I think we all get texts now, right, when there's an IPO coming up, which is interesting. But I think the way to think about these or these types of companies is it's a very concentrated investment, first of all. So it's a very high risk investment in a developing part of the world. So not only do you have the concentration element, you also have, I guess, the developing world element to it as well. So when we're thinking about these types of companies, they are very high risk investments. So the way I would think about these is to take a portion of your money. So if it's something that you're really interested in doing, then what I would always suggest is that you have the core. I made the joke about the family fortress earlier, but that's the pot of money that is there that is going to be robust. It's not going to do anything too crazy. It's just going to grow and deliver the financial future that you want 10, 20, 30 years from now. You should have most of your money invested in there. And then if you want to basically carve off an investment play pit, so to speak, that is where these types of investments would go. So what I would say is that should be 5 to 10% of your total portfolio, 15 at an absolute max. I know some people who suggest as little as 2, which I appreciate maybe doesn't quite scratch the itch, but I personally would suggest anywhere from 5 to 10%, and that's the money that you can then go and invest in the likes of local IPOs. Because look, if it goes really well, then brilliant, right? That's a nice sort of cherry on top and a nice boost on your way towards financial freedom. But if it goes badly, which is ultimately the risk with these things, then it's not really going to impact your long-term future all that much. It's not going to mean that you've got to work for 5 extra years, or your children can't go to university, or whatever the case may be. So that's the way that I would think about investments into single companies, and in particular high risk local IPOs.
Thanks a lot, Adam. I'll go to the next question now. What are the parameters and weightage of those parameters when comparing stocks like EPS or free cash flow?
Yes, sorry, what was the start of the question? I heard EPS and cash flow. Could you just repeat this?
I'll repeat. What are the parameters and weightage of those parameters when comparing stocks like EPS or free cash flow?
Yeah, good question. So this is probably slightly different to the I guess the subject matter we've covered today. So this is probably more so in relation to single company investing. So that's not something really that we would be advocating, especially today when it's sort of an introductory to sort of investing. I think I saw somebody else mention index funds, for example, in another question. So that's the type of investing that really should be your first experience with investing. If we're talking about an introduction to investing, most people should be starting out with things like index funds. So again, broad market investing in pretty much every major company in the world. When you start talking about, I guess, investing ratios and things like EPS and Sharpe ratios and free cash flow and all this kind of stuff, that's more relevant to people who are trying to day trade, who are picking individual stocks, and that's something that, like, if you're doing that kind of work, then absolutely you're going to need to understand those things. But I think for a general audience who are looking to just grow their wealth over time, they will be completely fine using broad market ETFs, index funds, things like that, rather than investing in individual stocks. So 99% of people shouldn't be investing in individual stocks.
Great. The next one has actually 3 parts of the questions. So number 1 goes like, do you have Islamic funds in your portfolio?
So me personally, I'm not sure, maybe the context of the question is getting lost a little bit.
Yeah, even honestly, when I didn't get that.
Yeah, so me personally,
and then the person is asking, is there a minimum ticket size or a lock-in period?
So yeah, there's a few different I guess aspects to this. So which I think I see the question now in the box, and I'm wondering if maybe that came in just before I went through some of the Shariah points. I'm not sure if I've answered some of this already or not, but let me just tick it off anyway. So on Islamic funds, if you're talking about my personal portfolio, then no. Do I have clients invested in Shariah compliant funds? Then yes. Do we offer it as a business? Yes, we're completely independent. So what we do is based on what the client needs. So if the client has a requirement for Shariah compliant funds, then it's our job to go out and build a portfolio that suits that. So we do. In terms of the minimum ticket size they went on to, or lock-in period. So I'll just address one and the other, I suppose. So in terms of minimum ticket size, for investing, no. We as a firm do have a minimum, I guess, client size or AUM amount, which is typically around $250,000 US. Now that is not a hard minimum. It's just that's typically the point at which maybe things start to get a bit more complicated. You need wider advice and other things. Maybe the numbers are getting big enough that you're a bit nervous managing yourself. All of these types of things start to come into play. So that's why our minimum is there. But if you are slightly below that, but you are someone who's going to benefit from, you know, wider advice and taking advice, then we're always open to that. And we do offer sort of free introductory discovery calls where, you know, we'll try and get to know you, you get to know us, we see if it's a good match, and we take it from there if so, or if not, we can point you in the right direction. So that would be, I guess, the ticket size element to it. It's not necessarily to invest, it's more to work with Abacus. We have a minimum client size. Then on the lock-in period, that would be a no. And this is actually something that I feel quite strongly about. It's something that you see in the UAE in particular a lot, because the UAE is still a developing part of the world. Now, if you look at other more developed markets like the US or the UK or Europe or Australia, places like this, lock-in periods are generally related to commission. And commission is banned in most of those places. So because the UAE, again, there's lots to love about living in the UAE where everything is developing and it's a fast pace, and you know, you look out your window and the skyline looks different every 2 months. But one of the bad things is, yeah, and I'm sure if you look at your own industries, when you drill into the detail, rules and regulations and all the rest of it tend to be a little bit more lax and still developing. And so commission is still allowed here. And so there are some firms out there that will be, I guess, financial salespeople more than actual advisors. And so their role ultimately is to sell products, which will then result in the lockup period. So what's happening there is, if there's a lockup period, it means that the advisor, I use the word advisor lightly, but the advisor will have earned a big commission on day one, and that can be huge numbers sometimes. You know, we've seen 8, 9, 10, 12% sometimes even of your initial investment. So again, 100,000 gets invested, and 10,000 immediately is gone on day one from commission. And then what happens is the provider of the product says, we're not going to cover that, so we're going to claw that back from the end client. So they claw that 10,000 back from the client over the period, and that's why there's a lock-in, because it takes, say, 10 years. It's a fixed term, right? So it takes 10 years for us to claw that amount back. So yeah, if you see anything with a lock-in period or anything that says a fixed term, you know, it's a 5-year product or a 10-year product or anything like that, then that is a massive red flag. So we would never recommend anything that has a fixed term or a lockup period or anything like that. You know, obviously I did talk about the 5-year rule earlier and investing for the long term. Obviously you want to keep money invested for the long term. You know, the longer you can keep money invested, the more it's going to compound and snowball and grow, and the better off you're going to be. But ultimately, it is your money, so you should have access to it whenever you want. You know, if disaster strikes and you need to, you know, sell down your entire portfolio, if you log in today and it's worth $500,000, then that $500,000 you should be able to pull out and have back in your bank account within 2 or 3 days. So I think, yeah, maybe a slightly long-winded answer, because it's something that I see quite a lot in this part of the world that doesn't, I don't agree with. But no, ultimately, we don't use anything that has a lock-in period. And if you do see anything that ever has a lock-in period, then no, that's a huge red flag.
Thanks a lot for that one, Adam. I'll quickly move on to the next question. The person wants to know if investing in gold is a viable option.
Yeah, good question. So I think I touched on this a little bit in the presentation, and I think as part of a Shariah compliant portfolio, then yes, absolutely. But under normal circumstances, if you're someone who doesn't need a Shariah compliant portfolio, then gold doesn't typically tend to be the most efficient option. I guess if you want me to expand a little bit on that, it does relate to, I guess, the investing versus speculating angle. So gold is what we call a speculation. So it's a speculative asset rather than a genuine investment. And again, if you think about gold, it doesn't actually do anything, right? It sits there and it looks nice, but yeah, it doesn't really do anything. So again, it relies on that greater fool theory. It means somebody else needs to come along and pay more for it than what I paid. So it's not really an investment. An investment has to be productive. It has to produce some sort of cash flow. So again, stocks, for example, companies, they produce goods, services, they generate revenue, they generate cash flow. Properties, they will generate rental income, whereas gold is something that just sort of sits there. People will talk about it being a hedge against inflation, for example. Doesn't tend to be a particularly effective or efficient way of doing that. There are much better options out there, is what I would say, for someone who doesn't need a Shariah compliant portfolio. But if you are someone who does want a Shariah compliant portfolio, then gold is probably the best option available to you to fulfill that defensive element to the portfolio. And what I would say is I do actually know some people who have Shariah compliant portfolios and they have very high attitudes to risk and capacity for risk and all that kind of stuff. And they're actually very comfortable investing in stock markets, for example, and they actually don't have any gold within their Shariah compliant portfolio because they're comfortable with that 100% allocation to growth assets. And there's a way to do that as well, where, from a risk perspective, it's significantly less risk than, for example, investing in direct companies or single companies, like we had a couple of questions on. So in terms of the risk scale, it's way, way, way below that. And so people can sometimes be comfortable with that when they don't necessarily want gold in the portfolio and they've got no way to I guess, navigate the defensive element to the portfolio. So yeah, probably a big topic we could get into a lot of detail on, but hopefully that's useful. I think Shariah compliance, yes, for the defensive element of the portfolio, but otherwise it's not going to add huge value.
Great, thank you, Adam. The next one is, could you please recommend high dividend shares in Dubai financial market?
I think this is something that I actually can't do, right? So in terms of making specific recommendations, that is, I think, falls under regulated advice and all of that. And so I can't actually do that on a call with lots of people. We can obviously give direct advice to individuals, but yeah, it's not something, unfortunately, that I could, I guess, say on a wide call in front of a big audience for fear of getting into compliance trouble. But again, what I would say on that, which I know is not answering your question directly, so apologies on that, but what I would say is, again, that is going significantly higher on the risk scale. We're talking about buying individual companies, so direct company holdings, direct shares. So, when we're talking about building portfolios that are a split between defensive and growth assets, because people want a slightly more balanced risk profile, what you're talking about here is going all the way up to 100% equity, so stripping out all the defensive parts of the portfolio, and then going many, many multiples above that again by concentrating down into single individual companies. So it would be a very, very high risk way to invest your money. And going back to what I was saying earlier around the sort of family fortress and the core of your money, and then breaking off a sort of investing playpen, this would be the type of thing that would go into that investing playpen. So, if you took 5, 10, 15% of your money and you wanted to just, pick individual companies, whether that's, local Dubai companies, IPOs, things like that, that would all go in that sort of bucket, and make sure that it never sort of surpasses 5, 10 or max 15% of your total portfolio.
All right, thank you so much for that one. I believe we'll just take the last question for today.
Yeah.
I think the person has left, but let's just take the question. He's asking, there are some banks here in the UAE that are giving interest rates of 5 to 6% per annum for fixed deposit. Is this a good option? What are the average return you can get with bonds or stocks just to be able to benchmark?
Yeah, great question. And so, yes, great options. I know there's, WEO as an example is obviously one of the big ones in recent times. But there are quite a few that have popped up now offering quite high interest rates. And I think benchmarking is probably the key word there, along with time horizons. So if you remember sort of the graph that we put up around sort of inflation and cash, the reason interest rates, well, the reason that high interest rate is currently being offered is because interest rates are quite high. So I guess we take a step back. Inflation is basically what sets the benchmarking for all of this stuff in the economy. So as you're probably aware, over the last year or two, we've had quite high inflation. And from a central bank perspective, interest rates are the main tool that they use to control inflation. So when inflation goes a bit too high, they raise interest rates to try and pull inflation back down. So the main benefit, I guess, there is that if you have people borrowing lots of money, then that's going to be a lot more expensive. The interest rate that they it costs them to borrow money reduces, they borrow less, and hopefully cools inflation. But the other side to interest rates is obviously what you're talking about, which is savers. Savers also get that interest rate or get an interest rate on the money they have on deposit. So because inflation went up, interest rates then went up, you're now also getting good interest on your savings. But I think the key thing to remember is that because of that mechanic that I've just gone through, interest rates will always trail inflation. So if you're being offered 5% on cash, that interest rate, then that's because inflation was 6-7%, and actually inflation was at almost 12% not that long ago. But I think the key thing to remember here is that your timelines, that's what should ultimately dictate how your money gets sort of allocated across those 4 different asset types that we were talking about. So you're never really going to be able to grow your money properly by using accounts like that, because yes, you're being offered 5 or 6% now, but once inflation comes back down, interest rates come back down, that won't last. And so you'll always sort of tick along below inflation, which I think if you imagine the graph that I put up at the beginning in relation to cash versus inflation, you're always going to trail like that. So there will be periods like now when you get offered quite high interest rates, but it's only because inflation is even higher. So cash is basically always going to just trail inflation. And so the only real way to genuinely grow your money above inflation is to invest in productive assets like stocks and bonds and property, or gold even, in the Shariah compliant funds. So I think that's the first part of it, is that just remember that interest rates will always sort of just trail inflation, and that's why you're getting those high interest rates now. But as long as you're identifying money correctly, so this is short-term money, think about the 5-year rule, then it's great when we're offered high interest rates like now for that money. So again, think about the house example I went through earlier. So if you have 600,000 dirham and you're going to need that money to buy a house this time next year, you're not going to invest that money. But now when interest rates are quite high, that's a brilliant place to maybe park that money, right? Because now, between now and this time next year, you'll earn 5 or 6% on that money, and you'll have more money when you need to put down the deposit. So I think it shouldn't really change the way you behave with your money. You still should think about your money in terms of pots and timelines, but it's good sort of short-term maintenance, I suppose. So when interest rates are high, check your short-term pots of money. Check your emergency fund, for example, and any pots of money that you have set aside for big expenses and goals that you have coming down the track, and think, okay, well, now that interest rates are high, can I potentially move this money somewhere else for the next 6 months or the next 12 months or the next 18 months, however long it's going to be, that's offering a higher interest rate. So that's something that a lot of people have done recently. They've moved money that's just been sitting in Emirates NBD earning nothing to the likes of a WEO account, where they'll earn a little bit of interest in the meantime. So it's never going to be the answer for your long-term investing, but it is great maintenance to be doing on your short-term pots of money.
Lovely. That was great, Adam. We did go a little bit over time, but I'm happy that we were able to take all the questions. And thank you for the great session. Hope to see you soon again for another wonderful session. And thanks to each one of you for attending this session. We will see you all again next week for our next topic.